Okay guys, happy Monday. Hope you all had a good weekend. I hope 2020 is not killing your spirits too much with all the lockdown measures and life not coming back to normal. But I'm back again with some more videos talking about the markets, opportunities we do have that are arising. I want to just share with you my ideas, show you what I'm looking at, and this may help you with your trading ideas. And I'd like to hear some feedback in the comments below this video as well to tell me what you guys think about these setups that I'm looking at. So, got some Excel spreadsheets. I'm going to show you some historical data looking at the S&P 500, GDP growth, and why if Joe Biden wins and he pushes through this huge stimulus package that he's predicted to push through over around $2 trillion, how that will really support US equity markets, the S&P 500 in particular, and why I'll be looking to buy the S&P 500 long term if Joe Biden does take the House and the Congress in the US election. So that's really important. Then on the flip side, we have a really short bias towards the US dollar because interest rates are now very low. So the US dollar doesn't have that yield advantage over other currencies. So looking at going short the US dollar Mexican peso because the Mexican peso still does have an attractive interest rate that is differentiating from the US and means that you can earn an overnight carry over the next 6 months or so if the trend does go in the Mexican dollar's favor in terms of appreciation in the exchange rate, and you get that interest rate credit profit carry trade into your account overnight. We also have a long position for gold price in US dollars because of the stimulus package. So I'm going to break all of these trades down for you guys, show you exactly what I'm looking at, go over historical data on spreadsheets, show you how these trades have been working out for quite a long time, and that will hopefully give you a better idea of what I'm seeing and the opportunities I'm trying to trade right now. Guys, remember, subscribe, share your comments, come join my free Telegram channel as well on Telegram for free market analysis. I'll show you what's going on in the markets every day, and hopefully you can then join my trading team or take some of the education or just get the analysis for free, as it will help you in your day-to-day trading. So let's go over to the computer screen and let me show you what I'm looking at. Okay guys, so we're looking at the S&P 500, which is a potential good long-term buy opportunity for us in the markets. As long as Joe Biden can win the House of Representatives and the Senate, that will set up the stage for a blue wave, they call, of stimulus coming into the US economy that will, of course, help stock markets in the US rally even higher. Now, remember, the stock market is used for investors to express their view on GDP growth. So if the 500 biggest companies in the United States are expected to grow inside an economy which has high levels of spending, then that will mean the S&P 500 will move higher on higher earnings expectations. And we have to look at some of the leading economic indicators that predict GDP growth to get our historical basis on why we expect the economy to grow. So if we look at manufacturing PMI, which is very, very important, it predicts GDP growth with an 85% certainty. And you can see here, when the manufacturing is above the level of 50, we get positive prints of GDP growth. And when we get manufacturing PMI below the level of 50, we get negative prints of GDP growth highlighted here in red. So you can clearly see there's a very strong correlation between the two. And if we move across from ISM manufacturing, and we also look at services PMI, which is the services sector of the economy, then we can clearly see as well that the non-manufacturing index also predicts GDP growth with a very accurate accuracy of 85% as well. As you can clearly see here, when the service sector is below 50, we get negative prints of GDP. When it's above 50, we get positive prints of GDP. So what's important to understand about that is because if we look at ISM manufacturing and GDP growth side by side, if you look at ISM manufacturing and the S&P 500 side by side, you will start to see that the two are very, very closely correlated in terms of, sorry, I'm not sure why this is not showing up on the chart. Okay, that's very strange. Let me just save this and reopen it. I was trying to give you an example. Not sure why that's happened. Give me a sec, guys. Let me just close this down and reopen this spreadsheet. Looks like it's crashed. Okay, so just going to show you guys how much the manufacturing data actually predicts the S&P 500 returns And you can clearly see how closely correlated the two are, and why we must use the manufacturing to predict GDP growth, and then how we trade the S&P 500. So again, here we go. You can clearly see that highlighted in blue, we have the S&P 500 year-on-year returns, and highlighted in red, we have the manufacturing PMI. I remember manufacturing PMI predicts GDP growth, and if the economy is predicted to grow, then investors are going to buy the stock market now in anticipation that in a growing economy, the 500 biggest companies will earn more money. So they buy a stock market now in terms of using the S&P 500 as a forward indicator to predict GDP growth. And you can clearly see here how closely the manufacturing and S&P 500 follow each other, because, as I said, the manufacturing PMI is used to predict GDP growth, and then investors use the S&P 500 to price in their expectations of growth or contraction in the economy. So at the moment, the manufacturing PMI is above the level of 50. So that's indicating growth in the US economy at the moment over the next 6 to 12 months. If we go to the latest reading, we have manufacturing at 55, above the level of 50. And most importantly, new orders, which is seen as a leading economic indicator, and employment is starting to come back towards the level of 50. So if more people are coming into work, as people go back into getting back into their job in the United States, and new orders are coming through, that's indicating that manufacturing is going to continue to expand. And it's the same thing in the services sector. Employment is now starting to grow again. We've got business activity, which is seen as a leading economic indicator, and new orders pointing towards growth. So what that basically means is, if Joe Biden does win the presidency and he wins the House and the Senate, that extra stimulus bill that I've been talking about, a huge 1.8 trillion stimulus package, or even more maybe he can push if he gets both chambers of government, then that could really support additional spending in the economy. And then investors are going to buy the stock market now in anticipation that when the public start to spend again, the companies within the 500 index are going to be earning higher profits. And that does point towards a good long-term buy in the US stock market. Now, let's have a look at what happened after 2008. Exactly the same thing happened in 2008. After the financial crash in 2008, look how long the US was on a massive bull market in the stock markets, because again, huge stimulus came from the US government. At that time, it was only it was a huge amount of money. 900 billion was pumped into the economy by the US government. And then you had the central bank doing quantitative easing. And remember, quantitative easing is basically buying financial assets to inflate the prices of stocks, for an example, and that helps to structurally keep the market strong. And that's why you had this huge 10-year bull market in the US. And it's exactly the same what the Federal Reserve has done. Again, buying financial assets, propping up the prices of equities, which is stocks. And it now sets the stage for fiscal support to come along again. And that helps the S&P 500 move to the upside. So again, a really good potential buying opportunity here as well. So interesting setups at the moment. Let's see if Joe Biden does take the House and the Senate. And if he does, then we get an opportunity to be buying the S&P 500 long term. Thank you. Okay, guys, so we have a potential buying opportunity for gold prices quoted in US dollars. And we have seen gold have a dramatic rise since 2019. And remember, this is because all of the stimulus that's been pumped into the US economy by the central bank and the government, and most importantly, long-term bond yields. So the interest paid on government debt has steadily been declining. So investors cannot protect themselves against the risk of inflation by buying safe haven bonds, which is usually the preferred choice of an investment for an investor who just wants to preserve the wealth of their investments or their capital and not lose each dollar or certain amount of value of each dollar due to inflation. So what we can see here from this Excel spreadsheet is that you can see here we have a 10-year bond yield, the interest paid on a 10-year bond yield minus a 2% inflation rate per year. And then you start to see that we've been seeing government 10-year bond yields declining on a structural downtrend going back to since 2008. And every time the bond yield was going lower, gold prices in red are going higher, because as the yield is going into a negative territory, so as soon as we get below the level of zero, which basically means investors are not getting paid any interest on their bond investments over the rate of inflation. So basically, that their dollars are losing value. Investors have to find an alternative to preserve their wealth. And this is why we have gold prices moving to the upside when bond yields are falling. And it's happened again aggressively this year when bond yields were declining aggressively because of the coronavirus pandemic. Since 2018, it's actually been happening on a downtrend. You've seen gold prices rallying aggressively because investors are now actually losing 1.25% of each dollar they hold because of a negative 10-year bond yield once you take out a 2% expected inflation rate per year. So investors have to protect themselves against the value from their dollars, the value of their dollars. And then we've got now Joe Biden expected to win the election, and he's expected to take the House and the Senate, and he's expected to be able to push a big stimulus bill through the US Congress. And that would mean a lot of spending in the US economy, and that would potentially be very inflationary. So again, if that does ignite inflation, then investors again have to protect themselves against their wealth, and they're doing it by buying stocks, and they're doing it by buying gold. So we have seen gold in this range where it was actually declining from the all-time highs it reached this year of over $2,000 an ounce, and it's now declined. But we have now started to see some higher lows forming, so the prices are now pushing back to the upside. But if we can get now a break above this short-term trend line on a technical basis, and we get above this trend line, and we start to see gold prices pushing to the upside, then that will signify that this long-term trend that we've been seeing in gold prices moving higher, as you can clearly see here, going back a while, this should continue. And if you look at the bigger picture, since 2008, when the financial crash happened, gold prices have done nothing but rally higher because all the extra stimulus is inflationary. Bond yields are going lower on government debt because the central bank has to suppress the interest that government pays on its debt because it's now running such a huge deficit in its taxation compared to how much it's spending. And then, of course, they need to be able to borrow at low rates of interest. So the central bank is helping the government borrow at low rates of interest to maintain GDP growth. Once you have a GDP debt, so once you have a debt to GDP ratio over 100%, you have to suppress interest rates. So that's a buying opportunity in gold prices. If we get above this trend line here, we understand the fundamentals driving gold higher because investors can no longer buy a 10-year government bond and protect themselves against inflation because now the bond is not protecting any of their dollar values from inflation in the future. So investors have to look for an alternative to protect their wealth. So they're going to buy gold, and that will obviously protect themselves. So let's say inflation is 2%, and you're losing, say, 1.25% if you buy a bond yield. But if gold goes up by 60% in a year, then you've more than protected the wealth of your investments. If you're in the stock markets, for an example, or if you're just sitting on cash, you want to preserve the wealth of that cash. So gold in 2020 is up so far 30%. So then you get a bigger picture to understand that gold is a good hedge against the devaluation of money due to inflation and huge amounts of stimulus being pumped into the economy. So I hope that makes sense, guys. A strong break above the trend line. That's a good buy. And that's the fundamentals behind gold prices potentially moving higher over the long term. Okay, guys, so we have a potential short opportunity for the US dollar against the Mexican peso. Now, we got to remember at the moment, the dollar is structurally getting weaker, not just against the Mexican peso, but against all the currencies in the world. And if we're looking at the dollar index and we look at the DXY, you can see this playing out at the moment over the long term since the coronavirus pandemic did cause the dollar to get stronger at the beginning of the year. But then that strength has unwound since the US central bank has been cutting interest rates in the US aggressively to try to help the economy. Now, remember, interest rates play a huge role in the value of currencies and exchange rates because of the difference in interest rates between two countries can mean you either receive a positive interest rate credit into your account or you pay out a debit out of your account, depending on which direction you're trading a currency pair. So the Mexican peso is very attractive to sell, The Mexican peso is very attractive to buy against the US dollar because Mexico has a higher interest rate than the United States at the moment. So if you do sell this currency pair and you held your trade over a 1 year period, you would receive a 4% interest rate credit into your account because of the difference in the rates for funding this trade using US dollars and investing in the Mexican peso. So if you have a look at the US dollar, the US economy, the interest rate at the moment, the interbank rate is 0.21%. The interest rate in Mexico is 4.72%. So if we put this into our spreadsheet, we can clearly see that if we are to sell the currency pair, then we're going to be receiving a 4.5% credit into our account on the amount of lots that we buy in a trade over a 1 year period. Or if he was to buy the US dollar, we'd be paying out 4.451%. So you'll be losing money on the trade because of the difference in interest rates. So remember, if you are buying Mexican pesos and you're selling US dollars to do so, so you're owning US dollars, selling US dollars to buy Mexican pesos, the amount of Mexican pesos you buy, you're going to receive an interest of 4.72% on the amount of Mexican pesos you buy, and that's going to even pay you a daily amount. Or if you're buying the US dollar, you're going to be losing 4.51%. You're going to be paying out, 4.51% of the amount of dollars you've used to buy the Mexican peso. So clearly it doesn't make any sense to be buying the US dollar against Mexican peso. And here we have an example. If we are trading one lot of US dollars and we're buying Mexican pesos, we're only paying out 0.21% in interest on the dollars we've borrowed to invest in the Mexican peso, but we're receiving 4.72% interest. So you can clearly see that means that we will be receiving a daily credit of our account of $13 a day, for an example, if you're trading one lot. Of course, if you're trading bigger lots, you're receiving more money. And we're not even factoring in the fact that if the currency then starts to move to the downside and appreciates in value in the exchange rate as well, you're going to make money off the appreciation in the currency's value alongside the interest rate differential. So that's the reason why if you go on Bloomberg, you read a lot of reports, a lot of interest-seeking yield investors are short the US dollar Mexican peso because of this interest rate differential between the two. Now, if we get past the low of the previous low set, which is coming up now, and we have a 1 month volatility stop loss of around 7%, then that will give you your stop loss range and your take profit target. We could aim for around 19 because that's the lows of the year that we started off on before the pandemic caused the dollar to get really strong when markets crashed in early April. So that's a trade I'm looking at the moment anyway. At the moment, as soon as you do break past these lows here, I've set some alarms on my charts, and that can be a good short-term trade. Thank you.